Good afternoon, everybody. This is Brian Rauscher from FS Insight. I am the Global Portfolio Strategist, and we're here today for my first live idea webinar. We're going to be talking about a lot of different topics today. We're going to be talking mainly about the sectors that were most asked about by our subscribers, and also the single stocks that we're also asked the most about. So here we go today. Here we go. We're going to cover a lot of ground. We're probably going to go for about 45 minutes. We may go an hour. I'm going to try to get in as many single stocks as I can. And hopefully you'll find it informative, and we'll go from there. Before I get started, I did want to just lay out some ground rules in perspective. The first thing I always want to explain to our people on the line today. Number one, all the research heads here at Fundstrat, FSI, I should say, use their own unique research techniques and may also focus on different investment time horizons. Some of us were more tactical, medium term, or strategic. With that, the views provided today are my own, and they were independently derived by my process and my indicators. Since my views are independently derived, they may be different than my colleagues. So today, these are Brian's views based on my tools. Today's agenda, we're going to have a little bit of a brief macro market update. Then we're going to dive into sectors, then the single stocks. Then I will talk about some stocks that stand out to me, and then we'll have some final conclusions at the end. So let's talk about the market and the market update. Here are the big conclusions. I've been writing about most of these topics and conclusions for the last several months. Number one, in my view, the Fed will likely be battling inflation through year end at minimum. Just looking at the data over the last week, where we had a hot employment report number on Friday. We had a hot CPI number this week, and we also had a hot PPI number. Ultimately, inflation will peak and roll over, but the Fed and its battle of getting inflation down is going to take some time, in my opinion, and through year end is at least the minimum, may even drift into parts of next year. The forward profit expectations are still too high for corporate America, and most likely will need to be lowered. I use this description in my writing, saying this is going to be a negative earnings revision cycle. And at some point, we'll reach what I describe as maximum pessimism, where those profit expectations get lowered too far. Now, why this is important, and I've outlined this in some of my weekly Whispers product, is that my research shows that the market has never made, at least since 1990, a sustainable bottom without us reaching max pessimism on those earnings revisions first. This is very critical in my process and the way I see the world. And I have written about it, and I will continue to write about it, updating on where I think we are in this process. I've been targeting 36 to 3,500 for the S&P 500. I do believe, based on my work, that we are going to head down there. And please note, I've also been writing recently that there's a very high likelihood that I will probably have to introduce an even lower outlook. So you might want to pay attention for that in the days and weeks to come. From a, how to position for the money that you do have allocated into the market. My work has been suggesting that we need to begin to shift away from cyclical related names and areas, value stocks, and move more towards growthier areas. That would be both a mix of both defensive growth and offensive growth. So the bottom line here from the macro update for me is that we still have to watch our overall risk exposure, because in my work, downside risk remains. There is more than likely going to be a good buying opportunity for investors, but my work still suggests that that's on the horizon. I think we need to be alert for new information that may alter this base case, maybe a surprise peace deal out of Russia and Ukraine. Maybe the market has a very sharp sell-off and we have to change the timing of my outlook. So we'll be on the alert for that. But for right now, caution, being careful, and watching our risk exposure is still very, very important based on my work. So let's talk about overall sectors. When we did my monthly sector update, what you see on the screen here on page 5 is my new sector weights as of the beginning of this month. You can see the green and red arrows, which were the directional changes. And you can see here that I am most above benchmark in healthcare and staples. I'm also a tilt above on technology, energy, and utilities. And you can see the below benchmark areas, mainly financials, industrials, materials, and consumer discretionary. Now, if you look at that sector recommendations, very consistent with what I talked about earlier. This is consistent with what I've been talking about. We have some defensive growthier names, which are the healthcare and the staples. We still have a little bit of offensive growth, which would be the non-cyclical part of technology. And clearly, the things that are below benchmark are all either considered more cyclical or more value-oriented areas. Now, let's dive in a little bit more about the sectors that were most requested by our subscribers. The top sector that people wanted to know about was technology. And as I mentioned from that page earlier, my recommendation there is a tilt above benchmark. And what we have on the screen is one of my analytical tools, which you may have read about in our sector updates, which I call an 8-panel analysis. And at the beginning of the video today, we were showing my tutorial on how to interpret the 8-panel analysis. So I'm not going to dive into this in a lot of detail here, but I am going to highlight some key points. The first key point for any area that I evaluate at the sector or the sub-industry level, we always start at this second chart down. And this is a proprietary metric that I developed over the last 2 decades for earnings revisions. I call it ASM, which stands for Analyst Sentiment Measure. And this metric is built to move from high points to low points over time. And generally speaking, when this ASM line, after it has fallen and begins to roll back up, is when we generally start to get interested in things. And one of the things you'll see here for technology, although on your screen it's going to look like this ASM line recently has been falling, or I'm starting to see on the higher frequency data, the most aggressive, is that this ASM line here for technology is beginning to roll up, which would be in this trend here, another higher low. And when we look at the earnings revision indicator, when that happens, that's usually pretty supportive for a group if we look at its relative performance when we go forward. So my expectation here is that this ASM line for the technology sector is going to start to show signs of rolling up and moving back into this green box that I put on this page here. If this does indeed occur, there's a very high likelihood based on history that technology should be an outperforming sector. And it's one of the main reasons why I am still above benchmark technology. We turn our attention here to the right side. You see these 3 charts here on the right side with this word PRO, price reversion oscillator. This has historically been a very valuable tool to help myself and my clients to determine when we might have a good opportunity to enter or exit a particular idea. And one of the things that we have here for the tech sector relative to the market, you notice here that we are what I describe as in the southern hemisphere, and we're beginning to roll back up. And you can start to see here that we're beginning to move back up again. And the 52-week is likely going to need a little more time before it does that. But the fact that this 13 and 26-week metrics are beginning to roll up is suggesting for this metric that the group should start to have relative tailwinds. Now, historically, when we take relative tailwinds from the right side of this chart and we combine it with an ASM line, which is either about to turn back up in this case, or has already rolled up and is moving higher, that usually bodes well for future outperformance. So this is the technology sector. It's one of the reasons why I continue to have it as an above benchmark group. If we now go to the second most requested sector, before I get there, this is now another tool that you may have remember that I use, which is called Halo. Halo is a tool which helps me determine high quality entry and exit points. Again, it's a supplemental tool to the 8 panel. And in this chart here, the indicator is the blue line. So this is what my model says that the technology sector is likely to do as we move forward. And the black line here is the relative performance of the tech sector. And like a lot of my proprietary tools, these tools are built to go from high points down to low points. So normally I like to be new buyers and put new money to work down in these areas. And I generally want to be lightening up when we have these higher areas. And one thing you'll notice here for technology space is that this Halo indicator bottomed, I don't know, about a month or two ago. And it's been slowly been rising here. Now, the sector hasn't been a huge outperformer just yet, but you'll notice that when this Halo line began to get positively sloped, the amount of underperformance by the tech sector versus the market has been holding its own. It hasn't made any new relative lows. With this Halo line still positively sloped and not yet near an extreme, which would be in this somewhere inside this green box, I suspect that the tech sector should be, at worst, a market performer, and more than likely, based on all the evidence, should start to become an outperforming area. Now, tech has had a rough start to this year, but it looks like as we move forward, that technology should start to become one of the outperforming areas of the market. So what we're going to do now is shift over to the next most requested sector, which is energy, which I have had at tilt above benchmark. If people have been reading along, it was full above benchmark until about March. And that is when I downgraded it from full above benchmark to tilt above benchmark, as the research then was suggesting that the risk reward was beginning to move a little bit against us. So why have we kept it at tilt above? Well, the first thing here from the earnings revisions, if you remember, this is one of the most important things for me. You'll notice here that this earnings revision line has been in a very strong and powerful positive slope. This began right around November of 2020, which is when I initially upgraded the sector for the first time for many years. As this has been rising, I have been somewhere above neutral. So right now, although it's elevated, we still have precedent for it to go higher. It's showing zero signs of rolling over yet. It's hard for me to get fully bearish on an area of the market if this earnings revision metric, ASM, is positively sloped. So this is what keeps me above neutral. Now, one of the things that has been happening with energy, in my opinion, is let's look at now to this right-hand side, and you'll notice something on all three charts. This is when we bought energy, where I'm putting these green circles, when it was at the low end of its range. And look where we got recently here over the last couple of months. We got what I call into this extreme measurement on all these metrics. This was telling us that energy relative to the market on 13, 26, and 52-week basis at least since 1990, were the most overbought that the sector had ever been by at least 1 or 2 standard deviations, which when that happens, regardless of what the earnings revisions are, a group can begin to have to consolidate those gains, start acting poorly in a short-term time period. So I think what energy has been reflecting here is that these lines had to get closer to neutral. And this is where it now starts to get real interesting. So thank you, everybody, for participating. And I will say goodbye. Please send feedback on the call on what I did well and what I didn't do well. So when we do future calls, we can make the changes. And I want to thank you from myself and my colleagues for being loyal FS Insights subscribers. And I look forward to talking with you again. Have a nice day.